Crude oil just posted a massive 8.27% weekly surge, completely defying the consensus narrative that global tensions are finally cooling off. Welcome to the D-Risk Weekly Global Markets Brief. It's Saturday, July 25th, 2026. Our theme this week is the phantom risk premium. The biggest dislocation in macro markets right now is the glaring contradiction between qualitative sentiment and hard price action. The headlines are telling us that a geopolitical exhale is giving risk assets a green light, yet the energy tape is aggressively bidding up supply fears while tech valuations quietly crack under the surface. Alex, let's start with the international tape, Asia and Europe.
Thanks, Sarah. In Asia, the surface numbers are lying to us. The Nikkei posted a weekly gain of 0.73% to close at 64,611, but this minor bump masks a severe structural breakdown. The index suffered a violent Friday sell-off driven by U.S. tech capex fears, decisively breaking below its 50-day moving average of 66,909 despite a longer-term golden cross. The Hang Seng also closed higher by 1.63% to 24,963. However, it remains trapped under a bearish death cross, with the 50-day moving average at 24,634 sitting well below the 200-day at 25,764. This means Asian capital is experiencing a dead cat bounce rather than a fundamental recovery. Europe, on the other hand, is catching a clean bid. Germany's DAX rallied 1.08% to close at 25,099, shaking off midweek tariff anxieties to maintain a pristine golden cross structure above its key moving averages. The UK's FTSE 100 similarly rallied 1.28% to 10,736, riding strong trend continuation without any fundamental shocks to derail the buyers. The divergence is clear. European equities are absorbing capital smoothly, while Asian markets are buckling under the weight of semiconductor anxieties and technical resistance. Sarah, back to you.
That stark divergence between Europe's clean capital absorption and Asia's semiconductor-driven breakdowns raises a critical question for domestic portfolios. If global tech anxiety is already fracturing the Nikkei's technical structure despite a positive weekly close, how is Wall Street handling the pressure of this rotation? Alex, break down the U.S. and cross-asset signal.
The pressure is forcing a clear internal rotation, Sarah. Looking at U.S. futures, the Nasdaq 100 slid 1.18% to 28,282, taking the brunt of the tech repricing. Meanwhile, the S&P 500 drifted 0.03% to 7,448, and the Dow Jones drifted higher by 0.44% to 52,124. Capital isn't fleeing the equity market. It is simply abandoning high beta tech for blue chip safety. In the bond market, we are flying blind on the 2-year Treasury this week, so we will focus entirely on the long end. The 10-year yield edged up 0.86% to close at a highly restrictive 4.71%, keeping the pressure on growth valuations. This elevated yield environment provided a tailwind for the U.S. dollar index, which edged up 0.71% to 101.47, maintaining a strong golden cross with its 50-day moving average at 100.25, sitting comfortably above the 200-day. In commodities, we see the ultimate tension. The news cycle claims supply fears are fading, yet crude oil surged 8.27% to close at 89, reclaiming support above its moving averages. That massive 8.27% weekly surge in oil completely contradicts the narrative of a geopolitical exhale. Conversely, gold posted weekly gain of 1.37% to 4,068, but remains technically broken under an active death cross. Finally, the VIX edged down to 18.58, signaling a slight reduction in immediate fear, though it remains elevated enough to warrant caution. Sarah, back to you.
Thanks, Alex. The disconnect between a complacent news cycle and aggressive commodity bidding proves that the phantom risk premium is actively distorting capital flows. When crude oil posts a massive 8.27% weekly surge while the media declares a geopolitical exhale, you know the phantom risk premium is quietly setting a trap for under-hedged portfolios. Looking ahead, all eyes are on the Federal Reserve and Bank of Japan rate decisions next week. If the Fed maintains a hawkish posture, expect the 10-year yield to break decisively above that 4.71% level we saw today, which will accelerate the rotation out of tech. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.